Welcome back to the channel, everyone. Sorry it's taken a wee while to get an upload back going. I was sick for a little while in Colombia in a place called Minka, and I've only actually just gotten to a place where it's been good to record. A lot of the dorms have been way too loud and noisy to get some good content going for everyone. So without further ado, let's get stuck in and see how the portfolio did for the month of May. So first on the list we had Alliance Bernstein Holdings. AB paid its second payment of the year, which turned out to be $5 New Zealand dollars and 27 cents. This now brings the yearly total paid by AB to $10 New Zealand dollars and 67 cents. One positive for Alliance Bernstein Holdings is that as of last month, the assets under management have been unchanged from April 2023, when it steadily grew to $676 billion USD, even after analysts suspected a drop. For the month of May, the stock is up 0.64%. While I'm currently in limbo with travelling and not receiving consistent paychecks, I don't plan on investing more into the stock apart from reinvesting its dividends. Instead, I'll just let it tick over and hope to start to add more to my position once I get back to having some financial stability. Next on the list, we had Abrdn Income Credit Strategies Fund. ACP paid a dividend of $1 New Zealand dollar and 56 cents, which brings the yearly total paid out by ACP to $7 New Zealand dollars and 67 cents. As I've said multiple times now in past videos, I'm still looking to sell the stock at a sell price of around 11.2 USD, which will keep me at a zero-sum loss. It is trading at a price close to 50% lower than when I bought it in 2021. Not only that, but of more recent time, it's been down negative 22.5% over the past year compared to the US capital markets, which has only dropped by negative 3.2%. Again, if we look at the earnings and revenue from October 2022, you can see that's still in the red by a large amount. I look to sell earlier if they cut their dividends sooner than expected. However, currently I'm reinvesting any dividends paid by the stock into positions I favour more, such as BST or Horizon. Next on the list, we had AGNC Investment Corp. These guys paid out $1 New Zealand dollar and 92 cents for this month, bringing the yearly total paid by AGNC to $9 New Zealand dollars and 31 cents. The reason behind the slightly higher payment was due to reinvesting the dividend from AGNC itself, as well as exchange rates at the time of payment. Next month's dividend has already gone ex-dividend and will continue to pay 12 US cents per share. It's still worth reinvesting the dividend month over month, as the company is trading at a discounted rate, approximately 61% under its fair value, which is an absolute bargain at the moment, as it's predicted that their return on equity will be 20% after 3 years. However, it should be noted that this isn't a sure thing. AGNC hasn't had the best financial performance record with their dividend. In the past 5 years, it dropped 33%, going from 18 cents per share to 12 cents per share. The reason behind this performance has been the historical bad housing market, which has been plagued by high interest rates, low supply, and high home prices. At the moment, interest rates are still higher than average, and according to Rithm, the number of new listed homes in the States has declined 28% year over year, which is not good for the current situation in terms of their ability to perform in the market. As if less people are buying homes, AGNC has less of an opportunity to issue mortgages. Regardless of this, I can't help look past the discounted rate and believe that supply will catch up over the next 10 to 20 year period, meaning that now is more than perfect time to buy AGNC. Next on the list, we have BlackRock Science and Technology Fund. This time around, I was paid $1 New Zealand dollar and 90 cents from BST compared to last month's $1 New Zealand dollar and 70 cents, due to the fact that I have been reinvesting other companies' dividends back into BST rather than just their own dividend. The yearly total paid by BST now sits at $8 New Zealand dollars and 43 cents. There have been some exciting developments in AI as of recent, and although BST doesn't directly build and develop AI itself, it offers investors exposure to certain companies that do. Although this is a more conservative way of trying to get a piece of the artificial intelligence pie instead of directly investing into up-and-coming golden egg AI startup, it offers great exposure to other tech fields, plus a dependable dividend, which I always try to find with companies I invest in. For the month of May, BST experienced a gain of 4.95%, and for the year thus far, it has experienced an increase in price of 20.51%. As you can see, their balance sheet and current cash flow depict a positive trend on their performance as of late. They've been able to generate positive cash flow and have started to recover from their losses they made in 2020 and 2021. Our fifth payment came from Ellington Financial. EFC paid out $5 New Zealand dollars and 64 cents. which brings the yearly total to 21 New Zealand dollars and 29 cents. Interestingly enough, EFC has been listed as one of the fastest growing small cap stocks of 2023. The metric was based off their most recent quarterly year-over-year percentage revenue growth and their most recent year-over-year earnings per share growth. As you can see, EFC had a 911% growth in revenue. This is to be taken for a grain of salt, as choosing to measure only one growth metric could be a misrepresentation of the business's actual success. As EFC is a mortgage and consumer loan company, this boost in revenue could be directly related to the rising interest rates we've been experiencing as of late. In saying that, EFC managed to add $100 million in equity, which would have also boosted their revenue. It's also interesting to see that EFC themselves are repurchasing back large amounts of the stock due to its attractively low share price in relation to their book value. This in itself is a great indication to continue to grow your position in the stock if you have spare cash available to do so. Moving on, we also had a payment from Eaton Vance. ETY paid a slightly increased dividend of $2.90 compared to $2.44 last month, due purely to the better exchange rates for the New Zealand dollar against the US dollar on the day of payment. The yearly total paid by ETY now sits at $10.65. Eaton Vance, who is indirectly owned by Morgan Stanley, has not had the strongest balance sheet of recent, with 2022 hurting the company quite a lot. However, if we look at their 2021 performance, you would expect that the profit margins made would be enough to offset any losses of 2022 and 2023. The dividend per share is still sitting at 0.08 US cents per share after being cut in 2022. If we look back in time far enough to July 2021, we can see that the DPS was at 0.0843 US cents per share. It then grew in August 2021 to 0.0929 US cents per share once the company started to return a profit. Based on that, I'm hopeful that although ETY has reduced its DPS, it will only be a temporary reduction, which will be increased once the company starts to again turn a profit. I won't continue to invest until I get a better understanding on their Q2 results, as it will give a better indication on how much they will run a deficit and in turn the amount of time it would take to recover if possible. Alright, next on the list is one of my more favourite companies, Fastneal. Fast paid its second dividend this year of $1.58. This is a solid company with a great dividend growth record and a solid balance sheet with multiple years of back-to-back performance. They've been able to pay down their debt since 2018, which has reduced their debt-to-equity ratio from 21% to 12%. I couldn't recommend these guys enough, but unfortunately position here is tiny, just like my position in JPG is. I would like it to be larger due to the multiple positive signs. However, with JPG, the amount of capital required to have a sizable dividend payment is beyond what I can invest at this point in time. If I stretch out that investment across many years, at my current rate, it will take me close to 30 to 40 years before I start to receive a sizable payment from Fast. I find that I can get to my dividend income goals quicker via investing in other stocks, albeit the greater risk and potentially less promising signs of growth and security. As Fastneal is a major supplier of industrial and construction supplies, I can see them maintaining solid growth over the next few years due mostly to the global shortage of houses and demand for more, meaning that there will be ample business for them to capitalize on. Therefore, I'll continue to buy in Fast when I can. We had another monthly dividend paid from Rithm Finance Corp, with that clocking up $9.39, which brings the yearly total to $45.51. Their balance sheet is looking strong as their book value is on an upwards trend. In the last month, Rithm was able to increase its credit facility to $250 million from $177 million, which essentially allows Rithm to greatly increase its profits and its ability to lend out more money and therefore receive a greater pool of interest payments. It's positive to see current forward earnings for Rithm are sitting at a multiple of 7.6 times its current rate, along with estimates of 16% earnings growth for the rest of the year. If you have any spare cash, it's definitely a great stock to buy, both for its current dividend and future growth. Another monthly dividend payer came through in the form of PCES, or Prospect Capital Corp. They paid a monthly dividend of 0.06 US cents per share, which resulted in a payment of 17 New Zealand dollars and 91 cents, and a yearly total income of 85 New Zealand dollars and 45 cents. Quarterly earnings have beat analyst estimates by 0.02 US cents per share. Compared to a year ago, earnings per share is up 0.04 USD. Interesting enough, their net asset value is down, which isn't a great sign, as it's showing either PSC weakening ability to earn money or the fact that they are starting to overstretch themselves with taking on more liabilities than they should. However, on a positive note, they have managed to increase their net investment income compared to 1 year ago, which is due to the rising interest rates and PCSC's ability to charge more on the loans they issue. As far as BDC goes, I won't be buying more of this stock this month, apart from reinvesting a dividend. I instead will look to invest in other BDCs such as Horizon or BST. We also had a monthly dividend payment from QALD, which resulted in a payment of $2.69, bringing the yearly total to $13.10. Again, with this company, I do not plan on reinvesting the dividend back into QALD, but instead into more profitable investments. We had our second payment from Rithm Capital of $7.63, which landed the total paid out by the stock to $14.88. Over the past few years, Rithm Capital has started to evolve into different markets, which differ from its core mortgage investment business, such as business lending, single-family rentals, and other asset management services. It also just purchased 50% of Green Barn Investment Group, who specialize in commercial real estate equity investments. It's also established a European segment of the business, which allows the company to be less reliant on the US market through diversification. Rithm Capital has decent dividend coverage at this point in time, with a payout ratio of 71%, which allows reinvestment back in the company for growth. Their financials are looking good, with Rhythm's earnings per share being at 0.35 US cents per share, which is up 13% from last year. The DPS is at 0.25 US cents, which in my opinion is stable when measured against their earnings per share. Therefore, it's fair to say that an approximate estimate of the stock being undervalued by 28.5% is fair to say, especially as their pre-COVID price was close to $17.50. I'll try to direct more of my funds into this stock in the hopes that its future growth will provide consistent dividends to my portfolio, even though AGNC is much of a likeness in some ways. Our second to last payment came from Southern Corp Capital. These guys paid out its second dividend of the year, resulting in a payment of $22.27, bringing the total paid out to $43.75. One of the reasons I bought into this company was due to the potential rise in the need for non-ferrous metals as the world heads into an electrified dependency in regards to electric vehicles, heavy appliance households, and the storage and transportation of electricity. Gold and silver prices have gained in price over the first quarter of the year as a hedge against the stock market and bank interest rates. Copper prices started strong but dropped after demand was less than expected. A good thing for copper prices, and therefore SCCO, is that the growth of copper mined products is projected to reduce from 5% to 3% in 2023, which is due to adverse weather conditions, equipment failures, and community actions in Peru. Therefore, there will be a deficit in copper production, which will cause an increase in copper prices and hopefully temporary higher profits for SCCO. Additional positive signs as of recent for the company include the return on capital employed being way above the industry standard of 12%. SCCO's currently sits at 27%. Return on capital shows how much pre-tax income a company earns on capital invested in its business, which indicates there is currently a lot of opportunities to invest capital internally for growth. In my opinion, this stock is a strong buy at this point in time due to demand for non-ferrous metals, which won't be slowing down anytime soon, and the company's strong financial position. Our final payment came from STAG, who paid out its clockwork monthly dividend of $3.66. The slight reduction in payment was a result of exchange rates alone and not due to STAG itself. Our current yearly total now sits at $18.04. Other than that, STAG saw quite a lot of positive changes. Their earnings per share estimates have increased from 0.65 US cents per share to 79 US cents per share for the year of 2023. At current, they're still on a bit of a discount considering their consensus price target has still not been reached yet. All in all, it's a great time to buy the stock.
So in summary, for May alone, we earned a total of $83.30. This represents an increase to May of 2022 of 132%. Our yearly total now sits at $918. With the coming of next month, we'll have finished quarter 2 and should be up above what we earned in quarter 2 of 2022. This month, our total portfolio value grew to $63,111, which represents a month-over-month change of 8% compared to its lesser amount of $62,000 last month. This represents a positive change in the markets and a slight recovery, although I do not believe we're over the worst of it yet. Our forecasted dividend was a little bit less than what we actually received, but within a $10 amount, which I'm more than happy with. Our end of the month portfolio dividend yield still sits at a respectable amount, coming in at 5.14%. I expect for next quarter we'll net an income of close to $260 to $270, and we'll provide an update when I have all the dividends received for the month of June. Look forward to you watching next time. Thanks.